good afternoon to you. We have organized this seminar on a clause-by-clause discussion on the provisions of the Finance Bill 2017. We will first take up the direct tax provisions, and we would also have a small break in between for tea. Before we start or we go headlong into the various clauses or various amendments which have been suggested or proposed in the Finance Bill 2017, I would request Mr. Ajay Vora, who is a senior advocate, to give his comments, opening comments in relation to the budget, and thereafter we will take up the clause-by-clause discussion. Mr. Vora, over to you. Thank you.
Thank you, Rupesh. Friends, a very good afternoon and welcome to this annual feature on clause-by-clause discussion of the Finance Bill. This year's budget, I think, has been historic in the sense that this came soon after the demonetization of 8th November. There have been differing views on the effect of demonetization, but one view that everybody agrees is that it has resulted in a shrinkage in demand. It has resulted in loss of GDP growth. And that's why people were looking forward to this budget to kickstart the economy. And therefore, there were huge expectations from the budget, and there are still huge expectations from what the Finance Bill seeks to roll out. In this bill, the government has envisaged the TEC agenda, what they call as Transform, Energize and Clean India. And in that context, the Finance Minister has laid out the roadmap for 10 themes that he thinks are central to the budget. And those themes are with respect to farmers, rural population, youth, poor and the underprivileged, infrastructure, financial sector, digital economy, public service, prudent fiscal management, and tax administration. And as all captains of industry have welcomed the budget, that with the huge spending that has been allocated for the infrastructure for the rural population, it should result in a demand push and consequently result in accelerating the growth in the economy. So in that respect, generally people have welcomed the budget. And what therefore needs to be seen is if the budget is able to achieve what it is intended and set out to do. I hope, and we are all optimistic, that in the years ahead, India will take its due place in the Committee of Nations, and the Indian economy will come back to being one of the fastest growing economies in the world. Now coming to the direct tax proposals for which we are all gathered here, I think the statistics that the Finance Minister read out about the taxpayers in the country is pretty alarming. And he said that as against estimated 4.2 crore persons engaged in organized sector employment, the number of individuals filing return for salary income are only 1.74 crores. It's a very small number, a minuscule number for a country of our size. Again then, for 5.6 crore informal sector individual enterprises and firms, the number of returns filed are only 1.81 crores. And then he says out of 13.94 lakh companies, only 5.97 lakh companies have filed the returns for the assessment year 16-17, out of which again 2.76 lakh companies have shown losses or zero income. So I think the statistics are extremely dismal that a population of 125 crores plus, and there are hardly any significant number of people who are filing their tax returns. I think this is going to change in the years to come as the government is using technology more and more to track down people who have disposable income, people who have taxable income and have not been filing their return. I remember in our pre-budget conversation many years ago, and I have stopped going because all the pleas fell on deaf ears, I had suggested to government that you should shift the focus from people who are filing their returns voluntarily to people who are not filing their returns. And I had suggested that in my assessment, the informal sector that they're talking of, people in the 2 to 10 lakh brackets are the ones where there is maximum evasion. Because people decide how much tax to pay, work backwards, show that much profit, and then work out the turnover. The government would do well to focus on people who have hitherto not been filing their returns, rather than, putting all their energies on the tax returns that are voluntarily filed. All of us here, I'm sure, represent companies which are filing their returns, facing scrutiny year after year, and you are going through the drill of filing appeals, running from pillar to post, trying to get the demand stayed and so on while the matters are pending in appeal. It is time that energies are now shifted to those who need to come into the tax net but have so far not been filing their returns. And I think the Income Tax Department would do well to make use of technology, data analytics, to find out these kind of people and bring them into the tax net. So the Finance Minister has outlined that the thrust of his budget is stimulating growth, relief to middle class, affordable housing, curbing black money, promoting digital economy, transparency of political funding, and simplification of tax administration. Now, clearly, these proposals are outlined to achieve these kind of objects that have been laid out by the Finance Minister, and we see many proposals in the Finance Bill geared towards these very proposed objects that he has outlined as part of his budget presentation. And we will be discussing many of these measures in detail in the ensuing discussion. I have just one or two points to make before I hand over the mic back to Rupesh. One is the effective use of technology that is currently being made by the government in order to track down deviant taxpayers and tax evaders. And this is bound to grow in the years to come. I think you can rest assured that technology will play its part. There will be notices to people, there will be track of transactions, and I am sure with this, the tax net will get widened and people will come in the threshold of paying taxes. That's one aspect. The second is the acronym that has been coined, RAPID, which talks of improving and simplifying tax administration. And RAPID stands for Revenue, Accountability, Probity, Information and Digitization. We will all welcome the simplification of tax administration. We'll all welcome reducing interface with the tax department, and we hope that there will be seamless filing of tax returns and the assessments without any pain, without any agony. This, I think, will go a long way in achieving the target that has been set out by the Finance Minister, because many people don't file their tax returns out of fear of being harassed by the tax department or victimized by the tax department. Many years ago, you will recall that a scheme was introduced for presumptive tax, and all taxi drivers were called upon to pay tax, those running taxis. I was talking once to a cab driver in Bombay, and he said in the first year, yes, he paid 700 rupees as tax, but subsequently did not file a return for fear of getting a notice. Now, if the tax administrators fall in line with what has been laid out by the Finance Minister, and we have trust imposed on the taxpayers by the tax department, I think this will go a long way in bringing many people voluntarily into the tax net who will seek to file their tax returns and disclose their correct income. So, in this sense, I think this budget is important given the direction and the impetus that the government has set out for improving tax collections and improving it in a conducive environment where there is little or less hostility between the taxpayer and the tax administrators. Thank you.
In fact, sir, the expectations were many more. Like, for example, that ICDS may be given a decent burial, MAD may be abolished, or several other, maybe the tax rate would be brought down drastically, which has happened only in relation to certain medium-sized companies, but not for all. So several expectations were there, which have been belied in the budget. So now we get into the nitty-gritties of the various amendments which have been made. We will be circulating the copies of this presentation. They would be with you in a short while. And also we have prepared a booklet which will be emailed to you, which is more comprehensive than the presentations. In the presentations, we have only touched upon the material amendments which have been made, not all the amendments. So the first slide is in relation to the individuals or personal taxation and the changes which have been made in the tax rates per into individuals. So as you would see, the two changes which are necessary to mention. First is in relation to those deriving income of rupees 2.5 lakhs up to rupees 5 lakhs. In their case, the basic tax rate has been reduced from 10 to 5%, as a result of which the effective tax rate in their case is reduced from 10.30 to 5.15%. That is one change. The other is that a new category or a new slab has been introduced. That is in relation to people deriving income above rupees 10 lakh and up to rupees 50 lakh. In that case, the tax rate has gone up because surcharge would be levied at 10%, which was not there earlier. So as a result of it, the effective tax rate of 30.9 has gone up to 33.99. And then you have incomes above rupees 1 crore, that is 35.53, which remains the same. Also under section 87A, a rebate is allowed under section of rupees 5,000 up to income of rupees 5 lakhs. Now, amendment has been made whereby the rebate amount has been reduced to 2,500 from 5,000 rupees, and also the qualifying, the threshold has been reduced from 5 lakh to 3.5 lakhs. So certain amendments have been made with reference to the National Pension System scheme. As you are aware, presently, at the time of closure or opting out of this National Pension Scheme, 40% of the amount which is paid suffers tax. There is also a provision under the NPS of partial withdrawal, and you can withdraw up to 25% of the contribution from the National Pension System. And it was not clear as to what would be the taxability in relation to this amount, whether it will suffer 40% tax or not. So it's not a case of closure or not a case of opting out, but the taxation implication in relation to this was not clear. Now it has been provided that this amount which you withdraw of 25% would not suffer tax. So what would happen is that at the time of opting out or at the time of closure, only the 75%, because 25 you are already withdrawn without payment of any tax. On the balance 75%, only 40% tax would be levied. So this would result in some tax saving to the individuals. Also in relation to those individuals who are not in employment under section 80 CCD, presently if you make contribution to this national pension scheme, you get deduction which is capped at 10% of the gross total income. Now this threshold, this amount has been increased, this percentage has increased from 10% to 20%. So if you can contribute up to 20% of the gross total income, which will qualify for deduction under section 80 CCD, but this is subject to the overall cap of 1.5 lakhs. So this amount cannot in any case exceed 1.5 lakhs, which is the overall cap. Under section 80 CCG, investment in certain listed equity shares or units of equity oriented funds, it qualifies for deduction. Now this is being phased out, and if you make any investment in relation to assessment year 18-19 onwards, you would not be entitled to this deduction. However, the investments which have been made in the past, because in the past the law was you could make investment in 1 year plus 2 years. So if you have made investment already, the 2 years time frame for making further investment would still be available, but the first investment cannot be made in relation to financial year 17-18 onwards. Now I come to certain amendments which have been made in relation to charitable trusts and institutions. So as you may be aware that presently, if a charitable institution or institution referred to in section 1023C of the Income Tax Act, if they make any contribution out of their current income to another trust which is registered under section 12A or to any trust or fund under section 1023C, then the same is considered as application of income in the hands of the donor trust. An amendment has been made whereby if you make this contribution or a grant or a donation to a section 12A or section 1023C fund or institution towards corpus of that trust or institution, it would not be considered as application of income. This is for the reason that the corpus amount which is received by a trust which is registered under 12A or 1023C, it is not considered as income of that trust. So to curb abuse or misuse of the provision, it has now been provided that out of current year income also, if any amount is towards corpus, then it would be treated not as application of income. Further, an amendment has been made to provide that in case of trusts or institutions which are already registered under Section 12A, if they modify their objects and the modified objects are not in conformity with the conditions on the basis of which the registration was granted, they would have to apply within the period of 30 days to the commissioner for grant of registration. In other words, it would be a fresh registration that they would have to seek. And in case they don't apply within those 30 days period, then the registration which was already granted to this institution would be of no consequence because the objects have been modified and the same are not in conformity with the conditions which were specified when the registration was granted. Yes.
So that is also the deeming condition for application of Section 12A. So that means in any modification made in the deed needs a fresh registration.
I would say that not any modification which is not as per the ethos or as per the conditions which were specified when the registration was granted. So if something which you are wanting to do which is totally different, totally alien to your objectives, then perhaps registration
yes, that
is
is
necessary.
what.
Yeah.
That means in the object clause, any change is made.
Yes.
Otherwise, also one is normally applying for and informing to the tax authorities
That's
for that.
right.
So now in the fresh registration is required for that also.
No, if what I'm saying that if within the overall objectives of what you are set up to do, if you add some other clauses, some other charitable activities which are in line with the activities which are already there, then it may not be necessary to get another registration done. But if there is something which is totally different than what or the conditions for which the registration was granted, then you would require it. So it will depend upon the nature of the amendment or nature of the modification which you want to do. So I would not say that in relation to all modifications you have to get a fresh registrations, but substantial modifications which you do which are not in line with your objectives, that certainly would require registration. Another important amendment which has been made is that the exemption under Section 11 or 12 to charitable trusts and institutions would not be allowed in case the return is not filed. These trusts and institutions are required to file return under Section 139(4)(a). Now, if you do not file the return within time stipulated under Section 139, then the exemption may not be granted under Section 11(12). So now it is mandatory in a way to file the return in order to get the benefit of 11 and 12. The amendment says within the time stipulated in Section 139 of the Act. So 139 would also include 139(4). So it is not necessary according to us that you file the return within 139(1) time frame. So even if you were to file a belated return under 139(4), the exemption would still be admissible. That is our reading of the amendment.
Even then it is required to be filed?
No, this would only be in a situation where you are required to file a return. So
Okay.
if your
If receipts is more than 2.5
yes,
lakh.
if your receipts are less than the threshold limit, then you are not required to, in any case, file the return, and therefore this provision.
But at
would-
the time of granting the approval under Section 12A, certain conditions are specified that you are required to file the returns every year. There is no limitation whether your income is taxable or not. But condition is that you are required to file the return.
No, then in that situation, you should file the return, because otherwise the conditions are violated,
Okay.
and it may result in withdrawal of the approval or registration continued in 12A. Now we move on to the amendments in relation to business income. So first is regarding the tax rates. So in case of domestic companies, and in order to give a boost of fillip to small and medium enterprises, it has now been provided that if these companies having turnover up to rupees 50 crores, the tax rate, which was presently 33.06, that is inclusive of surcharge and cesses, etc., would be reduced, and the basic rate is reduced from 30 to 25%, which would result in an effective tax rate of 27.55%. That is in relation to companies having turnover up to rupees 10 crores and income up to turnover up to 50 crores and income up to 10 crores. Where companies have income above 10 crores, but the turnover is 50 crores, the effective tax rate would be 28.84. So this is a major relief which the Finance Minister has given by bringing down drastically the tax rate by 5 basis points in relation to small and medium enterprises. Yes, that's right. So that was because 16-17 is still going on, and in order to avoid manipulation, etc., that is why. So you have to reckon this turnover with reference to financial year 15-16. That's now in order to move to a cashless economy, certain amendments have been made, and the amendments which affect computation of business income are in relation to section 43(1). So in relation, 43(1) defines actual cost of the asset. And now it is provided that if you make payment towards acquisition of an asset and the payment is made in cash above rupees 10,000, then you would not be entitled to depreciation in relation to that. So it would not enter the computation of actual cost of asset. Similarly, under section 35AD, wherein benefit is given in relation to capital expenditure in relation to certain specified businesses, there also, if the capital expenditure for which payment has been made exceeds rupees 10,000 in cash, the benefit would not be admissible. Now, under section 35AD, in case the asset is not put to the use, to the specified use as provided in this section, it is treated as business income in the year of violation. So you have to put that capital asset to certain specified uses only. If you don't do that, then the benefit which you got by way of deduction of capital expenditure, that is treated as business income. Now it has been provided that on this amount which has been disallowed as a business income, because you have put the asset to some other use, you will be entitled to depreciation. So this is a welcome provision. This was required. One thing which I want to point out is that under section 43(1), which leads to actual cost of asset, and 35AD, where disallowance is proposed in relation to cash expenditure above rupees 10,000, there is no exception like the ones provided in Rule 6DD, which applies to 40A3, but it has not been extended to section 35AD or 43(1). So there could be exceptional circumstances which are listed out in Rule 6DD, wherein payment in above rupees 10,000 could also be made. But that has not been extended to these two sections. So without exception, if the payment is above 10,000 in cash, it will be disallowed under these two provisions. In relation to specified banks and financial institutions, presently 7.5% of the adjusted total income is allowed as deduction towards bad and doubtful debts under 36(1)(7)(a). This 7.5% is proposed to be raised to 8.5%. Also, in relation to deductions under section 43D and 43B. So 43B is payments made in cash. So if you make payment of interest to a scheduled bank presently, then you are entitled to deduction under 43B only at the time of payment. Now, there was a dispute as to whether scheduled bank would include a cooperative bank or not. So now cooperative banks have been specifically included within the ambit of 43B. So if any interest is to be paid to a scheduled bank, that would be allowed only at the time of payment and not at the time of accrual. In fact, there was this Bombay High Court decision in case of CIT versus Upendra Kapadia, which held that non-payment of interest to cooperative bank would not attract provisions of 43B. So this decision would no longer be good law. Now, certain changes in relation to threshold for maintenance of books of accounts. So in relation to income from business or profession, other than professions specified in 44AA, the existing threshold for the purpose of maintenance of books of account is 1 lakh. Now that has been increased to 2.5 lakhs. And in relation to the turnover, there's another threshold with reference to the turnover, which is presently 10 lakhs. That has been increased to 25 lakhs. Also, the threshold limit for applicability of presumptive taxation in case of eligible businesses carried on by eligible assessees was increased from 1 crore to 2 crores by the Finance Act 2016. And it was thereafter clarified that that if a person opts for this presumptive taxation, he will not be required to get his accounts audited under Section 44AB of the Act. Now it has been statutorily provided that there will be no requirement to get the accounts audited under 44AB in relation to these people. Also under Section 44AD, there is a presumptive basis of taxation of at the rate of 8% total turnover of gross receipts, not exceeding 2 crores in a previous year. Again, in order to give fillip to cashless transactions, it is now provided that 6% and not 8% of the total turnover would be the income liable to tax under 44AD in relation to receipts which are in modes other than cash. So if you get payments to electronically or checks, etc., that would suffer tax at the rate of 6% and not 8%.
And this is up to the return of income, up to the date of...
Yes, this is also important. And this is if you get the amount before the date of the return of income. So there could be a situation where you have accrued certain income by 31st March, but the payment has not been received. If you receive the payment before the due date of filing the return of income of the relevant previous year by means other than cash, then that would also qualify for tax at the rate of 6%, not 8%.
So I think the tax audit report should provide how will you then estimate how much of it is received in cash.
Yes. Maybe up to the date of the tax audit report.
So somebody will need to certify it, no?
Certify, that's
right. I would think so.
Yes. One more
I think that may be required.
Yes. Now, certain amendments, and an important amendment in relation to Section 10AA of the Income Tax Act, which pertains to deductions in this, of undertakings or units in special economic zones. Now, there has been a controversy whether this provision of Section 10AA and also in fact 10A and 10B are these deduction provisions or these are exemptions provisions. Because if we read the language of the section, it talks about deduction. So it says that deduction would be allowed in computing the total income. However, the placement of this section is under Chapter 3, which relates to exempt income. And depending upon how you look at it, if you look at it exemption provision, then the tax treatment is different. If you look at deduction, it as deduction, then the tax treatment is different. Because if it is exemption, then it doesn't enter the computation of total income at all. But if it's a deduction, then another issue has been at what stage you need to give the deduction. Because the language of section is in computing total income, deduction in computing total income. But then at what stage? At the stage of computing business income, that is PGBP, or after GTI, that is gross total income, or even thereafter from total income. And there have been a lot of judicial decisions either way, but the predominant view of the courts was that having regard to the language of the section, the deduction should be allowed at the first stage, that is at the time of computation of PGBP, and not from the GTI. So it is not like a Chapter 6A deduction. So it needs to be excluded right at the first stage, which is at the stage of computation of PGBP. That is what was held by the Karnataka High Court in Yokogawa and several other decisions of several other courts. Supreme Court also in the case of Yokogawa, that it confirmed the decision of the Karnataka High Court, and it held, and it's a very recent decision, and though it was in the context of Section 10A, the language is more or less similar to 10AA, and the court held that it's a deduction provision. However, that you need to exclude the income right at the stage of computing the PGBP and not from GTI or not from the total income. This is not the view which is shared actually by CBDT. In fact, CBDT had come out with a circular earlier taking a different view, but the Supreme Court had ruled otherwise. Supreme Court's view was different. Now, in order to get over this ruling of the Supreme Court, an explanation is inserted in the proviso to section 10AA to clarify that the deduction in relation to units on undertaking under special economic zone, situated in special economic zone, would be allowed from the total income of the undertaking. So this is a new concept now. So the deduction would be allowed from the total income of the undertaking. As you are aware, under the Income Tax Act, the levy is with reference to total income. Now an issue which would arise is that what is total income? Is the levy of tax with reference to the income prior to the deduction under 10AA or after? So the law has not been comprehensively amended in the sense that total income has not been, the definition of total income has not been changed. So total income is gross total income less deduction under chapter 6A. So this is not a deduction under chapter 6A. So this is a new concept that after total income, you reduce this amount and you come to certain income. Now the issue would still remain that levy of tax under section 4 is different total income. But is this the total income? So that is one issue which would continue to be there. Secondly, what has also been provided is that this amount would be with reference to would not exceed the amount of total income. So therefore, if your total income is in the negative, so because let's say carry forward of losses of earlier years, or because of chapter 6A deduction it is nil, then also you don't get deduction of 10AA, which was not the case earlier. In the position as explained by the Supreme Court was that you could reduce the amount right at the first stage. So you did not have to pay tax. Now you have a situation where if you have losses or the nil income, then you don't get deduction at all. So we have plotted, there is this table which would show the impact of this amendment. So you have a situation A where the eligible unit, that is under section 10AA, it is let's say its profits are 30 and non-eligible unit's profits are 70. So before the amendment, the gross total income was 70 because as the court said that you don't have to consider as part of PGBP. So your GTI would be 70, not 100. 30 is the amount which you get under 10AA. And so total income remains 70. Even after the amendment, it's the same because both eligible business and non-eligible unit have positive incomes. The issue arises where eligible unit has a positive income and the non-eligible unit has a negative income. So if you see case B, we have rupees 30 of income in eligible unit and non-eligible unit has a negative, there's a loss of 70. Now before the amendment, the GTI was still 70 because 30 you could exclude at the first stage itself and your total income was negative of 70, which you could carry forward. But after the amendment, what's going to happen is that your total income is, you will have to set off the two, it will be 40. So you will be entitled to set off only rupees 40 going ahead. Effectively 30 has been set off. In relation to other instances, cases where eligible unit has a loss and non-eligible unit has a profit, the situation remains the same. So only case where this amendment would have impact is the one referred to in case B here. So you have any, Mr. Vora, you have any comments in relation to the the stage at which this amount will be deducted and how do you tax it? Because total income, under section 4, the levy is reference to total income. Now what is this amount when you reduce from total income? So what is the resultant figure? Can you say that this is the new total income and you levy charge of tax with reference to this amount?
No, I think your total income is the ultimate stage on which you actually pay tax. Prior to that you have the gross total income and then total income after chapter 6A.
But sir, if we see the amendment, what it says is that deduction is to be allowed from total income of the assessee and not from the total income of the undertaking.
No, you see the question, why the words used are total income of the assessee and total income of the undertaking. is, in this judgment of Yokogawa, the Supreme Court has interpreted to say that the words total income will mean total income. The word used in 10A is total income of the